Sources of finance.
Once upon a time, a young man called Rahul wanted to expand his business, but he was confused. How would he raise the extra funds for his business?
I know. I'll ask Grandpa for his advice. Grandpa, I plan to expand my business, but I am confused about the various sources to raise funds.
Nothing can beat retained earnings to finance your business. Since it is your own money, you can save on interest and principal repayment.
What is right? What is not? Grandpa, can you please explain to me in detail?
All right.
Retained earnings refer to the undistributed profits from companies which are usually kept in the form of general reserve. Primarily, it is a hedge against low profits in future and is used for the issue of bonus shares by the company. But in effect, it acts as an important source of long-term finance for the companies with zero costs of capital. The retained profits can be used for expansion and modernization programs by the companies.
Grandpa, how do we determine retained earnings?
The amount of retained earnings is determined by the quantum of profits, the dividend payout policy followed by the management, the legal provisions for dividend payment, and the rate of corporate taxes, etc.
Retained earnings is an internal source of finance. There are no flotation costs involved in retained earnings, since it is the company's own finance and hence does not involve the uncertainties of external finance. In fact, it is regarded as the most dependable source of long-term finance. It also strengthens the firm's equity base, which enables to borrow at better terms and conditions.
What? Demerits of using our own funds?
The main drawbacks of this source of finance are: it is fully dependent on the accuracy of profits, hence it is an uncertain source for funds. There is a possibility of reckless use of funds by the management. Excessive plowing back may cause dissatisfaction among the shareholders, as they would get lower dividends.
Rahul did not seem very pleased with the idea of retained earnings. He wondered if there were other sources that he could tap into. He decided to clear his doubts further.
Grandpa, are there any other sources of funds?
Why, yes. Apart from retained earnings, there is trade credit.
Trade credit? Trade credit refers to the credit granted to manufacturers and traders by suppliers of raw materials, finished goods, components, etc. Usually business enterprises buy goods on 30 to 90 days credit. This means that all the goods are delivered to the purchaser, but payments are not made until the expiry of the period of credit. This type of credit does not make the funds available in cash, but it facilitates purchases without making immediate payments for the same. This is as good as funding of the materials by suppliers for a certain period. This is a very popular source of short-term finance. Who can avail of trade credit? Trade credit is granted to those customers who have reasonable amount of financial standing and goodwill in the market. The volume and period of credit extended depends on factors such as reputation of the purchasing firm, financial position of the seller, volume of purchases, past records of payment, and degree of competition in the market. Terms of trade credit may vary from one industry to another and from one trader to another. A firm may also offer different credit terms to different customers. Merits of trade credit. Trade credit is a convenient and continuous source of funds. Trade credit may be readily available in case the creditworthiness of the customers is known to the seller. Businesses can buy now and pay later, which means even if they do not have the immediate funds at their disposal, they can make purchases and pay later within the stipulated time frame. Trade credit does not create any charge on the assets of the firm while providing funds. With trade credit, the business can focus on other areas such as sales, marketing, and research in immediate future. Demerits of trade credit. Availability of easy and flexible trade credit facilities may induce a firm to indulge in over-trading, which may turn out to be a risky proposition. There is a limit to the amount of funds which can be generated through trade credit. It is generally a costly source of funds as compared to most other sources of raising money. Explanation for the same is as follows. A quick look at utilization of trade credit by Walmart.
Rahul did not seem very pleased with the idea of retained earnings. He wondered if there were other sources that he could tap into. He decided to clear his doubts further.
Hello Rahul, how are you doing? Mohan, I need your help. I want to expand my business, but I'm confused about the various sources of finance.
Rahul, factoring is a very popular source of finance, but I'm a bit busy to explain the same to you in detail.
No issues. I am sure my grandpa would assist me in the same.
Next day, Rahul decided to gather some more information from his grandfather.
Grandpa, my friend Mohan, a banker by profession, suggested me factoring as one of the popular sources of finance. Can you please explain the same to me in detail?
Sure, why not, my child? Factoring. Factoring is a financial option for the management of receivables. To state simply, it is conversion of credit sales into cash. In case of factoring, a financial institution, factor, buys the accounts receivable of a company, client, and pays up to 80% of the amount immediately on agreement. The factoring company pays the remaining amount, balance 20%, finance cost minus operating cost, to the client when the customer pays the debt. Collection of debt from the customer is done either by the factor or the client depending upon the type of factoring. Examples are factoring against goods purchased, factoring for construction services, factoring against medical insurance.
These are three parties directly involved in factoring. The one who sells the receivable, the debtor, and the factor. The sale of the receivables essentially transfers the ownership of the receivables to the factor. Thus, the factor obtains the right to receive the payments made by the debtor for the invoice amount. Also, he must bear the loss if the debtor does not make the payment. Once the rights lie with the factor, seller should not make collections from the debtor. At times, the factor charges the seller a service charge as well as interest based on the wait period. The factor's overall profit is the difference between the price it paid for the invoice and the money received from the debtor, less the amount lost due to non-payment. Let us take a quick look at the benefits of factoring. Additional services provided by factors. A quick look at additional services provided by factors. Let us have a look at the RBI guidelines for factoring companies. Let us have a look at the merits of factoring. Demerits of factoring. This source is expensive when the invoices are numerous and smaller in amount. The advance finance provided by the factor firm is generally available at a higher interest cost than the usual rate of interest. The factor is a third party to the customer who may not feel comfortable while dealing with it. Factoring appeared on the Indian financial scene only in the early 90s as a result of RBI initiatives. The organizations that provide such services include SBI Factors and Commercial Services Limited, CanBank Factors Limited, Foremost Factors Limited, State Bank of India, Canara Bank, Punjab and National Bank, Allahabad Bank. In addition, many non-banking finance companies and other agencies provide factoring services.
That was so informative. I will surely try factoring. Thank you.
Hey, I have not done yet. I have yet to tell you about lease financing.
A lease is a contract between the owner of an asset, the leaser, and its user, the leasee, for the right to use the asset during a specified period in return for a mutually agreed periodic payment, the lease rentals. The important feature of a lease contract is separation of the ownership of the asset from its usage. Lease financing is based on the observation made by Donald B. Grant. Why own a cow when the milk is so cheap? All you really need is milk and not the cow. Benefits of leasing. The leasing industry plays an important role in the economic development of a country by providing money incentives to leasee. The leasee does not have to pay the cost of asset at the time of signing the contract of leases. Leasing contracts are more flexible so leasees can structure the leasing contracts according to their needs for finance. The leasee can also pass on the risk of obsolescence to the lessor by acquiring those appliances which have high technological obsolescence. Today, most of us are familiar with leases of houses, apartments, offices, etc. A quick look at various demerits of leasing. A quick look at various types of leases.
All this is pretty interesting. I have also heard about public deposits, but I believe that only companies can issue them.
You are right.
The deposits that are raised by organizations directly from the public are known as public deposits. Rates of interest offered on public deposits are usually higher than those offered on bank deposits. Public deposits can take care of both medium and short-term financial requirements of a business. The deposits are beneficial to both the depositor as well as to the organization. While the depositors get higher interest rate than that offered by banks, the cost of deposits to the company is less than the cost of borrowings from banks. Companies generally invite public deposits for a period up to 3 years. The acceptance of public deposits is regulated by the Reserve Bank of India. The public deposits are regulated by the provisions of the Companies Act and the Companies Acceptance of Deposit Rules 1979. A quick look at various merits of public deposits. A quick look at various demerits of public deposits. A quick look at a few infamous scams. There is one more source that should interest you. Commercial paper. Commercial paper is an unsecured and discounted promissory note issued to finance the short-term credit needs of large institutional buyers. Banks, corporations, and foreign governments commonly use this type of funding. An unsecured short-term debt instrument issued by a corporation, typically for the financing of accounts receivable, inventories, and meeting short-term liabilities. A quick look at commercial paper in India. Merits of commercial paper. Demerits of commercial paper. Facts about commercial paper which may interest you.
Thank you, Grandpa. You have provided me with invaluable information. Now I know so much more about the sources of finance.
Remember, there is no such thing as a perfect source of finance. Each source has its own merits and flaws. What is important is the risk-taking ability of the management, circumstances prevailing at that point of time, and of course, the need for finance.
Thank you, Grandpa. That is so true.